Welcome back, everyone. We are back to the AI Policy Summit, and now we are up for a real treat, namely a fireside with Gary Gensler. So Gary is, of course, the current chair of the Securities and Exchange Commission, but that's not only thing to mention about Gary. He was a former MIT faculty, and in particular, I had the privilege to have a number of very insightful conversations with him about policy and technology. So I'm sure he will have something very interesting to say here, especially since the moderator here is Dan Huttenlocher, the Dean of the Schwarzman College of Computing, and also someone that I know for a fact thinks very deeply about technology and society. So without further ado, Dan, please take it away.
Terrific. Thank you, Alexander. I'd like to just start with a little bit about Gary's history here, a brief history, just because I think it's picked some pieces that I think are relevant to our conversation in particular. So in addition to having been appointed by President Biden as chair of the U.S. Securities and Exchange Commission in February 2021, Chair Gensler has held presidentially appointed positions in two prior administrations as chair of the Commodity Futures Trading Commission in the Obama administration and Undersecretary of the Treasury for Domestic Finance and Assistant Secretary of the Treasury in the Clinton administration. He also worked closely with Senator Paul Sarbanes in passing the Sarbanes-Oxley Act, and as Alexander mentioned, has served as a faculty member at MIT and also worked in the private sector at Goldman Sachs. So he has a rare combination of private sector, academic, and government experience that I think is particularly relevant as we think about artificial intelligence and the way it's affecting so many aspects of our lives. And in fact, Chair Gensler has quite broadly recognized interest in AI policy, both before becoming SEC chair and since becoming chair. As chair, he's issued several remarks on the risks AI poses to the financial sector. He's asked Congress for funding around fintech activities in the AI space. And in his role at MIT, as Alexander mentioned, he was involved in a number of things, including writing a paper on deep learning, one of the early papers on deep learning and financial stability, looking at potential effects of AI in finance. So Gary, it's really welcome. It's super to be here with you today.
It's great to be with you, Dan, and with Alexander, and back, even if this little bit, in the MIT community.
Terrific. So I'd like to start with a topic area that actually draws on this rare combination of experience that you have across government, academia, and the private sector. You know, AI is all around us, and like many new technologies that have come before, it can bring enormous benefits, but also create significant risks. And it'd be great to hear a little bit about, you know, how you think we're doing with AI, in sort of your view. You know, where do we have adequate facility with AI? You know, both from a deployment perspective and a regulatory perspective. And, you know, in particular, how are government, academia, and the private sector doing relative to one another, and how might we work more closely together?
I think that we're living in a truly transformational time. I think it's every bit as transformational as the internet. Now, the internet itself, people say, how could something be as transformational? And that was about connectivity around the globe, about information and data, and dramatically lowering the cost of those data transmissions. But I think that the transformation now is every bit as big and maybe bigger in terms of predictive data analytics and what it can mean. And I'm not just talking about those Star Wars fans that are just delighted that AI is going to bring us James Earl Jones as Darth Vader, you know, or if you wish, if you love, you know, Iceman and Top Gun and everything, and Val Kilmer was in there. It's not just that; it's transforming so much of our society. In the world I live in, finance, it's transformational, but obviously in healthcare, and you know, how many years will it be before we have driverless cars and we really have them, and so forth. And so there are just so many areas that predictive data analytics is transformative, I believe. But I think, as you said, it brings public policy challenges, risk along the way, and we'll get into that more in our conversations. But that was true when the internet came along. It was true when radio and television came along. As new technologies come along, we as society still have certain public policy, I would say, goals. We embed them in laws, we embed them in regulation, but we still have basic things. At the Securities and Exchange Commission, well, we're an investor protection agency. So it's about, basically protecting the public from fraud, from manipulation, ensuring for fair access. We have a three-part mission, which is about investor protection on one side. I'll stop with the advertisement in a second, but investor protection on one side, facilitating people raising money. That's the other side, capital formation, and that which is in the middle, fair, orderly, and efficient markets. That's embedded in law. That doesn't change, given that we have these new tools or new activities. But I think it's transformational, Dan, but it does come with some risks.
So no, so actually the reminder for those who are not as familiar with the SEC's mission, I think is actually very apt, because when we think about AI, actually in all three aspects of the SEC mission, there's potentially significant relevance. So when we think about sort of orderly and efficient markets, and think about the kinds of things that we're starting to see with AI and various types of market players, are there particular things that you're focused on, or that you think we should be focusing? Are there questions academics should be asking? Just be great to hear a little bit about that.
So let me zoom out just a little bit to finance broader. Our remit at the SEC, we oversee $100 trillion capital markets. Well, maybe that's changed on a daily basis, but you get the picture. And but if I zoom out a little bit, deep learning, machine learning, predictive data analytics, if we might say, is already being adopted throughout finance, particularly as it relates to natural language processing and just documents being fed in, claims processing and insurance, the various voice recognition, the robo-advising that's going on, I would say, across consumer credit, very much in terms of the marketing and the engagement with the public. Claims processing, I already mentioned, but also some of the back office, fraud detection, anti-money laundering and the like. When it narrows down to what we do at the SEC, we have definitely seen robo-advising take off. What is robo-advising? It's basically automating the advice using a little bit of predictive data analytics based upon an investor's needs. We most definitely see it there. We see it, of course, in the marketing to customers as well. We're seeing it in the core of the capital markets through many large asset managers are now using predictive data analytics, again, machine learning and deep learning tools for sentiment analysis. I don't know if this MIT series today is all being picked up, but it's possible that somebody's feeding this whole conversation into sentiment analysis. And of course, if I was Jay Powell rather than Gary Gensler, you can be sure that somebody would be, feeding that all into sentiment analysis. And if he paused a little longer, or he hiccuped or laughed in the middle of something, some predictive data analytics would probably be reading that, and you don't know whether the bond market would move up or down on that. So it's being used across the land. I would say that going forward, and I'm sure you'll get into in the questions, projects, I think, just like other parts of the use, whether it's in the use in radiology, whether it's the use in social media, and whether it's used in driverless cars, we have the same sort of issues of robustness. Will the model fail in its fragility? But in finance, we have the robustness of the network itself. So it's not just the robustness of individual predictive models, it's the robustness of the network itself. And finance, and particularly the capital markets, are probably one of the globe's most complex networks. I mean, you can compete it with weather predictions and the like. But when you think of this, just all the variables and all the adversarial competition in our capital markets, we have those issues of robustness. We have the same issues of what I would call explainability that I'm sure this conference is deeply tied into. Can you explain to somebody you deny credit to why they've been denied that credit? And that's a really important thing we've embedded in laws 50 years ago in an Equal Credit Opportunity Act and the Fair Housing Act. And my colleague Rohit Chopra over at the Consumer Bureau, the Consumer Finance Protection Bureau, CFPB, has sort of done some things earlier this year in that space. And we at the SEC are looking at other things beyond that about conflicts of interest. Are you giving advice to somebody, but you're in essence thinking about your platform, your business's revenues, rather than thinking about your client, your investors' best interest or fiduciary duty? But back to you, Dan, and I'm sure you have more questions.
Oh, yeah, I mean, just that raises all kinds of questions. So maybe I'll dig in on the responsible sort of use side to start. So I think your point about sort of the robustness of the individual models and their interactions in a complex network is an extremely important issue. Maybe most apparent in financial markets because, as you said, of the high complexity of those networks. And, I don't claim to be any financial.
I would say this. I think you also have it in terms of driverless cars or the use in airlines and airplanes, because you think of networks. What is, if you're an air traffic controller and you've got all those planes coming in and out, I mean, that's a very complex network. And I remember others at MIT studied those networks, but even driverless cars. But I couldn't agree with you more. I think finance is every bit as complex, if not more complex, than those networks.
Yeah, no, absolutely. And I think, one of the interesting things from the academic front is, in transportation networks and particularly, in the development of self-driving vehicles, the approaches there, both from an academic perspective and the companies that are developing these, are fairly explicitly look at the network interactions between actors, although they're geospatially near one another to really matter. And finance doesn't have that same kind of constraint.
And I'd also say there's something different when you think about the analytics and the incentive systems. Or the other way around, the incentive systems in when you're on a highway, and then the analytics to support it. Hopefully everybody's sort of looking for a safer road within some norms and some risk tolerances, right? And you don't want the other driver to crash. I mean, let's just take that as a given for 99+9% of people. Hopefully 100%. But in finance, you actually often have that you want to win and somebody else loses. Somebody's going long a security and somebody else is selling it. Somebody's shorting, somebody's going long. So you have sort of different game theory that's embedded in capital markets and has been for decades. What predictive data analytics brings is a new tool. And you and I have debated this, but it brings a new tool. And I think one of the interesting things for public policy, and again, this is true in hospital public policy, automobile public policy, social media, finance, is that we normally look to attach public policy to activities, how you drive your car on the highway, how you sell a security. We attach it to the entities. Are you a bank? Are you a broker dealer? Are you a stock exchange? Are you a hospital? The entity. Or the product. When you sell a crib, it's got to have certain consumer safety so that the child sleeping in that crib is safe. So products, entities, and activities. And here, arguably, you have a computer science tool that comes along, better predictive data analytics than when a guy like me was doing, stats back at Wharton years ago. And it's a new set of tools, but that tool is also becoming an activity, and how we bring that into our public policy regime.
Yeah, so I wanted to dig a little deeper on this sort of driving network versus financial network for a moment. I think in the driving network, as you said, the individual actors are, motivated to make the system stable and not just their individual vehicle stable. And certainly the developers of the vehicles are very motivated to do this, and the providers of services, traffic services and so forth. And the motivations in financial markets are more complex. Do you think that we might have actors, private actors who get more interested in the stability of that system by sort of analog to what's happening in something like driving? Do you think this is a place where there needs to be a lot more expertise in academia or in the government to be, sort of looking at the systemic stability with these kinds of advances in technology?
I think we've recognized this in multiple sectors of our economy, that there's trade-offs, that the individual actor is acting in one way, and then there's what's called externalities. And so it's a matter of a degree and spectrum. But I'd say in finance, the 2008 crisis, some of the things that are, look, even the events of the last 2 days in the markets and the volatility that we've seen in the markets as central banks, get some of their footing around what's happening in the United Kingdom in the last few days and so forth. There are always sort of actors that are looking at systemic issues, and nobody wants a financial meltdown, or I should say nearly nobody wants a financial meltdown, but the individual actors still have sometimes my gain is your loss because I'm long and you're short, or vice versa. And so I do think that I'm honored to be a member of what's called the Financial Stability Board, this G20 group around the globe that thinks of risk. I do think this is an emerging risk. And I do think that there's a risk that the crisis of 2027 or the crisis of 2034 is going to be embedded somewhere in predictive data analytics. It's part of it is the big changes, even in the 2 years since I left MIT, is in foundation models. If somebody is relying on, OpenAI or GPT-3s, or something that's equivalent in 2027, and there's some foundation model, that's a concentrated risk. And a lot of fintech companies could build on top of it. They could build some really innovative, interesting products for the public. But then you've got a node that is every bit as systemically relevant, maybe as a stock exchange, maybe as a clearinghouse, or a cloud provider if they went down. But now you've got that. Or if the foundation model is all pointing in one direction, and it's pointing in one direction in normal times, but what happens when you get to what's called a tail event? We in finance talk about tail events, and you can debate whether that's 5 standard deviations or 3 or whatever out. But what happens in the tail events when that foundation model is something everybody's working on? In insurance right now, there are many insurance underwriters that are starting to take telematics. This is the data that's coming off of your automobile. It's the data that you can upload and sort of underwrite that insurance. Well, what if one provider of all the telematics starts to be concentrated? And you might say, well, that's not going to be a capital markets risk. But then you migrate that over to what if that's in the US Treasury market or US stock market?
Yeah, so I think, again, a number of really interesting points in there. One I might follow up on a little bit more is, you use foundation models as an example of sort of potential risk concentration. And just, more generally, I think when we think about sort of the homogeneity versus heterogeneity of decision making, you have a lot of independent human actors making decisions based on, a wide variety of data sources. There's a lot of variability and heterogeneity there. Foundation models are one type of centralization, but, large shared training sets that might be used with very different models, but everyone's training on the same data set. Or there are a number of these sort of implicit places. How do you sort of start to identify them? Are there sort of behavioral signals you can see in a market that might indicate, or beyond markets in a given sector that might indicate these risks? How do you get ahead of these things?
Look, I always like to, those folks that can identify a problem and then say, here's the solution. But I would say this, the reality of the intersection of computer science, data, and economic incentives leads to what we economists would call network economics, that there's a reason why these foundation models, data sets that you mentioned, and otherwise might lead to a monoculture. It might lead, and for the listening public, foundation model is just a fancy word for models that might build the foundation. So think about your foundation of your house, for instance. And they really do take a massive amount of data. In fact, there's a couple here in the US that have built on every page that's ever been on the internet or Wikipedia or books online, every single page. And now you can take that, build certain models. Well, that takes a lot of resources, a lot of MIT grads in computer science, talent. So it's natural that there's going to be some dominant players. Or in a country like China, it's just funded by their government, and they want to have a centralized sort of foundation. What we know from science and biology, when you have monocultures, they're more frail. They're more susceptible to challenge and the like. So I just want to make sure we leave time, because I want to talk a little bit about some of the challenges around investor protection, if you wanted to ask me anything there. But I do think that there's financial stability issues. And to your question, how do we best identify it? I think first we have some honest discussions amongst the public, academia, and the official sector about, where do we see those natural network economics? Where do we see that somebody's aggregating, let's say, all of the mortgage data that's relevant, and that there's one big data set on mortgage data or one big data set rather than competing data sets? We know this on facial recognition. We know this on other data sets. There's some really key data sets that are being used in machine learning now outside of finance. But where is it going to happen in finance? Maybe it's the driverless cars point. We had one from the 1960s. It was called FICO. FICO, which is how we do consumer credit, was two data scientists from Stanford, Fair and Isaac, that started a company, the Fair Isaac Company. There you go. But FICO is probably, with all respect to FICO, it's probably in relative decline, right? Because all the alternative data sources that big banks can now tap into. And I'm not just talking about our rental and utility data. I was interested in a Senate banking hearing last week. I watched the CEOs of the major banks be asked about this very question, and they talked about rental and utility information. I mean, with all respect, that's not where this is going. This is going to all of your social media data, your Fitbit data, your telematics, as to are you, going to be marketed a certain financial product. And so I think those are the risks. But on to investor protection, maybe a question or two.
Yeah, that would be great. And I think we're about halfway through our time, I think. So I think we're still good. So maybe I'll start with consumer finance, if you like, or I could do investor. What do you prefer?
I'm an investor agency, and then I'll clean up on consumer finance.
So we sort of started, I guess, with that a little bit earlier on, just about the mandate of the SEC around investor protection, be great to, and we're seeing a lot happening now with, new types of entrants into the financial markets, providing new services, fintech companies, and be great to hear a little bit about how you're thinking about that, because so many of those companies are deploying very, very new technologies that are not necessarily well understood at this point.
So let me focus on the retail side, if I might, for a moment, for the listening public. We all know this. We can now sign up, and millions of Americans do sign up to get lower cost advice and lower cost brokerage services. On the advice side, sometimes we call them robo-advisors or wealth management services and the like, or brokerage apps on the other side. And literally millions of folks are doing this. Separately managed accounts in the US have grown over 70%, from about 32 million to something in the order of mid 55 million accounts in 5 years. Now, who are those new separately managed accounts? It's a lot of folks that are signing up by the millions and getting advice, no longer directly from humans, no longer from bricks and mortars, but from an app, a robo-advisor. And on the brokerage side, can be trading at very low cost, and they might not be getting technical advice, but behind the scenes, there's a lot of predictive data analytics. And that predictive data analytics, whether it's based on machine learning or not, can also differentially market. Dan, they might determine that you respond better to blue and I respond better to red prompts, or something more sophisticated. And what the businesses are generally doing, whether it's in consumer finance or in the capital markets, are looking to greater engagement. That the investing public, just like a Facebook might, just like other, Netflix might, is trying to bring you into greater engagement. Now, it's one thing if Netflix predicts that I like rom-coms, and I do, by the way, self-disclosed, I love rom-coms, there you got it. And they can predict and sort of put something up there. But now what does it mean when an app does? So one of the projects, and I know maybe the media is listening, I'm saying one of the projects we're doing here at the SEC is we went out to the public and we did what's called a request for comment in 2021. And we asked a whole bunch of questions, got a lot of feedback. Based on that, I have now asked staff to consider proposals for our 5-member commission that we might propose things around the investment advisory space and the brokerage space about inherent conflicts of interest. And for those of my former colleagues at MIT, you'd understand the question. If the algorithm, what I would call the optimization function, considers amongst its factors the profits or revenues or a proxy thereto of the application, therein lies an inherent conflict. So let me think about the hospital. A radiologist takes you in and scans some part of your body in one way or another. And what if the advice that came out of that scan was 100% about your health? Thumbs up, that's great. But what if the advice that came out of that radiology was in part optimized on the revenues of the hospital or the revenues of the doctor's practice? Now, in that case, we'd probably say that's a conflict that and I'm not an expert there, but that might sort of trample a little bit on the Hippocratic Oath. But now think about it in finance. What if the robo-advisor has a multi-factor optimization that includes something related to their revenues, their spreads, their margins, their profits, or a proxy there too? And so I've asked staff, how do we deal with that inherent conflict? And particularly if they're thinking about their marketing prompts and how they're selling to you, Dan, to get you steered to a higher margin product, maybe trading options when it's not really appropriate for you, or trading on a lot of margin, or just day trading a lot, or in the investment advisor space to more profits for them. And I just remind the listening public, it's sort of like that doctor or hospital sort of, do they have your interest at heart? and a fiduciary duty is embedded in our laws. And so my call to action maybe to the academics and computer scientists is to help people think through this, how you could sort of have a neutral algorithm that's not putting a platform or a business's revenue or profits ahead of the investing public. That's what we're trying to challenge ourselves to.
Well, as you said, this is a broad issue beyond the finance realm, or there's an analogous broad issue, which is that a lot of firms look to maximize engagement and engagement.
And in our capitalist system, they appropriately seek to maximize their shareholder value, not your shareholder value,
Yep.
but their shareholder value, their revenues, their profits. That's part of our economic system. But then, we come together, we pass laws through our appropriate legislative bodies and executives and everything. How do we balance that? And in finance, I would say it's a really important but narrow project. We're looking at conflicts of interest and the associated sales practices in both investment advisors, think robo-advisors, and in the brokerage space, that we really do achieve the duty of loyalty, where you're supposed to put your investor, your client's interest before that of the platform. That's called a fiduciary duty or best interest in the brokerage side. So that's what the systemic issues we talked about, and sentiment analysis and the monocultures is a challenging topic as well. It's something that we're looking at. We're talking to our counterparties around the globe. In reality, the private sector knows more about these issues than anyone in the official sector. I mean, and we have different incentives. We in the official sector, the central banks, the bank regulators, the finance ministries, the market regulators like ourselves, are really focused on the robustness of the system. And yet, while that's important to individual actors tend to be more thinking about the resiliency or robustness of their individual company, or even, frankly, what we found in the 2008 crisis, there were different parts of banks that were only interested in their little silo, and it brought down a bank that might have brought down an economy. So those are some of the things we're thinking about and working on. You wanted to ask about broader finance.
Well, no, actually, I was going to come back to the investor protection.
Okay, please.
So I think, the issues of sort of fiduciary responsibility, loyalty to the client, and not putting the firm in front. I mean, that's all over the place. Everything from front running your customers to and
what's interesting, Dan, if I can interrupt, this is not new. In a bricks and mortar world, we had these issues, and our Congress and other legislative bodies around the globe sort of adopted some sense to it. What's interesting is, with the vast, insatiable desire for data, and the ability to micro target. So we're into narrow casting our sales practices and our behavioral prompts, and some people call it gamification in some circumstances, to encourage engagement, encourage trading, or steer people to higher profit to the platform, not to the investors. That's not new, but one thing that's interesting is, with the analytics, we also actually have moved maybe from a more subjective decision set to a more objective decision set. And when I've asked staff, I've said, well, maybe that actually gives us some pathway to obviously working with market participants and working with public comment, that leaves a more, one might say, rigorous audit trail and books and records, and the decision. Now, then you stub your toe a little bit into the explainability issues that I'm sure your conference is also talking about. And this was a little bit, this is what my colleague Rohit Chopra over at the CFPB earlier this year, they put out something and said, look, the Equal Credit Opportunity Act, the Fair Housing Act, still, even with the modern technology, says you must be able to explain. I don't want to speak his law, but you need to be able to explain to a customer that you've denied credit to. That's a 50-year-old law. And so how do you explain that? In our investor protection space, we have different laws, but it gives you a sense of the overlap there.
Yeah, no, and I think, back to the, sort of legal regulatory side of AI policy, one of the questions that, we've been looking at throughout a series of things in the AI policy forum is, where do we really need specific AI regulations, and where actually do we need to think about how existing regulations and regulatory frameworks are directly applicable, but maybe both, private firms and regulators need to be sure that they're thinking about, how does AI figure with respect to those existing regulations?
Well, so I would say this, history has so many different times that new tools come along, and we generally don't write new laws or regulations about the new tools. A new hammer, do we write a law or rule about that? Now, you can push back and say this is a general application tool, and the tool is starting to look like an activity. But I still think in finance or in medical AI or in social media and so forth, we still have to think about, all right, we've come to some consensus through our legislative bodies, and we've adopted laws to protect the public, its safety, its health, investor protection, financial stability. And those are still tried and true public policies. And so that's how I think about it at the Securities and Exchange Commission. And so it's less to me about a new law or a new rule about artificial intelligence. It's about, wait, how do we make sure? Aristotle had this line, it probably doesn't translate quite right, about treating like things alike or something. And regulators often say that like activities should have the like regulation, because that's what we do. But it's really that, I think. And so now we have this predictive data analytics with remarkable abilities to predict things. We still have to sort of say in our remit, how do we protect the investor? How do we protect them particularly against conflicts? We do know through various understandings that sometimes people are optimizing on their revenues and not on their clients. And there's a fiduciary duty on investment advisors. There's a best interest responsibility on broker dealers. In essence, it comes down to an old thing that, my mom would understand if she was still alive. It was just like, are you putting your client's interest ahead of your own? And then how could you do that mathematically in the data? I think in the consumer finance area and in the investor protection area, we have the real challenge that the data itself has embedded in inherent inequities society. And there's biases in the data that then will come out in the decision making. And I think that's why we haven't seen as much adoption in Maine, like credit card companies and consumer credit, because there is a concern about this very real issue and challenge. And it's certainly a bit of a call to action to the academic computer scientists is how to ensure that we don't and somehow embed those inequities and inequalities through the predictive data analytics and whatever features that are in there, which partly relates to explainability, but I think it's a deeper issue than just explainability.
No, I would offer a little bit of a sort of challenging, catch-22 situation where we seem to be in today, which is, on the one hand, we were talking before about sort of monoculture and fragility and potentially increasing systemic risk, but to the degree to which you get some carefully vetted data sets that have been carefully looked at for bias and so forth, and then people all use those data sets, that's actually a plus. So compared to maybe just some data sets that companies have had around.
Absolutely,
So,
but there's a trade-off. So you get this really cleaned up, whatever that would mean, data set that you think appropriate, doesn't have those biases in it. But then you have a trade-off that's, and that's a good positive outcome. By the way, there's positive outcomes to foundation models too. There's positive outcomes. You started with the important question about this technology. I think it is transformational. Every bit as transformational as the internet, and and whether it's got good and bad. I mean, driverless trucks. There's 2 million people that are employed in this country, I think, driving trucks and so forth. So what does it mean in terms of employment? There's all those trade-offs that come with new technologies. We've just talked about some as it relates to finance, is about, guarding against the inherent conflicts of promoting engagement over the client's interest. Clearly, the financial stability issues and monocultures and how we guard that, particularly in complex networks like finance, maybe even in complex networks elsewhere, that all the decision making sort of leans one way, and it works and feels good until it doesn't, and so these are some of the exciting challenges, and I applaud you all for having the conference. And I know Alexander, I should say, the first time I met Alexander, I walked into his office, I knocked on his door as like a Sloan faculty member, and I wasn't sure he would even let me in his room, over at Computer Science Land. And I said, how should I learn this subject about AI? And he kind of was going to, toss me out of his office, but he said, here, I'll hand you this textbook, go read it. And if you read it, you can come back. And I slugged through it for 6 or 9 months, and I came back, and I think I surprised him that I'd read through all my linear algebra was pretty rusty by that point in time, but I had read through it all. And that's how we formed a relationship. And why I tell that story, I really think one of the challenges is bringing people from different disciplines together. The disciplines of the theoretic, AI, machine learning, like an Alexander Madre, bringing together, frankly, some practitioners. I guess I was a practitioner from finance and public policy, but, my computer science days were 40 years ago in Fortran and BASIC and APL. But bringing those different disciplines together, and I would say one of the challenges is folks in jobs like mine have big, busy portfolios. I mean, if you're a central banker, you're dealing with the economy and monetary policy and financial stability issues and banking capital, and your job like mine, it's all the things we're dealing with, the capital markets and thinking about how we make our markets more efficient, more protect investors, facilitate capital formation, that $100 trillion. And then there's this project that might be a problem in 5 or 8 or 15 years for financial stability, is currently a challenge for investor protection through the conflicts and fiduciary duty. But any help that we can get in the official sector, from the public, from the private sector who's using the tools, and I still call them tools, but using the tools, in the academic community is terrific. But I think that's the challenge, bringing those different disciplines together in academia, but bringing them together with those of us in the public sector who have the privilege. I mean, it's a privilege. I'll do my time, and then somebody else will be in this job 5 years from now or something.
Well, Gary, thank you so much. And I can't resist pointing out that your sort of closing comments there are an amazing advertisement for what we're doing in the Schwarzman College of Computing at MIT. We have a big focus on what we call bilingual computing, people who have expertise in computing and in another disciplines so that they can act in those sort of translation and liaison roles between being experts in AI and being experts in finance or other sorts of domains. And it's a explicit educational and research objective. And then also a focus on the social and ethical and policy issues around computing, particularly AI. I
didn't know that. But I think we're moved on from the general policies. There's hundreds of these AI policy documents, and what folks, and it's not just me. I have the honor of chairing an agency with 4,500 people. The folks at the agency are really focused on what do we do with regard to this very specific challenge about how predictive data analytics is being used in this way or that way. And so it's really down into sometimes just rolling up the sleeves and thinking about the granular. And that's what the team here does so well, but doing it and learning from the outside as well. So I hope you all stay well and healthy. I hope this was helpful, this conversation. You probably have other people in panels that are yet to come in.
Indeed. Well, Gary, thank you so much for your time and for the really extremely interesting and stimulating conversation, and quite a bit of depth.
Thank you.
Must be those years at MIT.
Oh my God. And thanks, Alexander and Louise and so forth. And I'm going to do a fun shout out to Connie and Phil, I think, who are friends, who are my girlfriend actually, and friend, who are watching this little program. So
terrific. Thank you so much.